Hello, I'm Chris Pedersen, and this is Stock Watch on Wednesday, the 8th of May, 2024. All information is general advice and may not be suitable for you. Always consult your advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few market observations. 1. RBA announced at 2:30 they're keeping rates on hold at 4.35%. Ignore interest rates, and investing in good companies is always going to be the way to go when you're looking for the long term. Interest rates will rise, they'll go down. That doesn't matter in the long haul. Look for companies with growth now and potential for continued growth. Income stocks are fine, especially here in Australia where you get franking credits. Later on I'm talking about the banks and you'll see what I mean. This chart here caught my eye. It's fascinating. Sydney ranks as the 8th largest in the world for millionaires. Now what is significant is, one, that we're 8th on the list, and two, if you're in the financial services industry, this says Sydney is the 8th best place to be marketing your products. Here's another chart. This says a lot more than it looks. This is the S&P 500 after World War II to just before COVID. I mean, what we know from COVID is the market dropped and it did come back. So why am I including this? Number one, when it comes to investing, markets always come back. You can see the bear markets, recessions, bear markets, markets go down. If you look closely, you can see that they go down. However, you also see they always come back and go to new highs. Thus, as an investor, do not worry about bear markets. Yes, they're going to happen. In fact, there's been like 14 of them since World War II. What is important to know is that the average length is less than a year. The average drop is around 30%, so that's significant when you're living through it. But when you look back, it is nothing. Hold your good positions, and you know the markets will turn around, make new highs. Who makes the money in green energy? Well, this is all the various countries, and green is China. I don't need to say more. That this whole green revolution, the one place that is taking all our money is China. Thank you very much. 5 top cities in the world in terms of average intelligence levels. Well, Zurich's number 1, Oslo number 2, Canberra, that's number 3. That is shocking. It's not surprising. Australians have very high levels of education. I mean, you look at universities, the top 150, we have quite a few, including University of Wollongong, which is around 130. Then you have University of Sydney, University of Melbourne, you have University of New South Wales. There's a plethora of top-rate universities. Foreign investments into China. This caught my eye just because it's actually a surprise, and it's a worry for Australia. The black lines obviously keep going up and up and up, and now look at the far right. Investments into China have collapsed. This is not necessarily good for China long term. However, China is transitioning away from real estate. They still have a lot of infrastructure spend, but they're increasing as planned their domestic internal consumer consumption. This helps their GDP. If you've noticed, China surprised on the upside recently with their forecasts. Now, this is a very important ratio that you need to learn if you're a serious investor. It's called the PEG ratio. The person who started using it is called Peter Lynch, a famous portfolio manager in the 80s, part of the 90s, and he managed the Magellan Fund in the US from 20 million up to 14 billion in a period of 13 years. His average rate of return was around 29% per year. That is absolutely phenomenal. Now, the PEG ratio is the following. It is the PE ratio of the company divided by the earnings per share growth rate. For example, XYZ is trading at 100. Next year's earnings estimate is $6. All right, so you take 100 divided by 6 and you get a PE of 16.7 times. Now you take the earnings per share growth rate. Let's just, for simplicity purposes, assume it's 10% per year on a compound annual growth rate. So now to get the PEG, you take 16.7 which is the PE. You divide it by the growth rate, and you get a ratio of 1.67. A PEG ratio below 1.0 is good. So this is above 1.0. So it's not that good. However, compared to a lot of large cap Australian companies, 1.67 is not that bad, but this is just a fictitious company for example purposes. Next two companies are big banks that have reported recently. End of last week, NAB reported, code NAB. It's trading right now in the ASX at $33.78. This is a 5-year chart. Now what you see is that it topped out, fell, and it's been rallying since around July, September of last year. It's had a very good run. But is this run justified? What's really driving it? Will it continue? Let's take a look at the fundamentals here. NAB has a market cap of $108 billion. I have a price target of $30, and a lot of other brokers have price targets around that, which is below its current price. The revenue growth rate from 2023 to 2026 is only 1.4% per annum. Their earnings per share growth in this period is like -1%. In other words, the earnings aren't growing. In fact, they're going backwards a teeny bit. Not a lot, but a little. We want growth. Dividend growth, well, we're getting a little bit here, but it's only 2.1%. So really looking at the numbers here, NAB is not going anywhere. It's sideways. Now let's look at the PE ratio. 2025 earnings estimate of $2.27 gives you a 14.9 PE. For banks, this is high. As I mentioned a couple of weeks ago, a PE over 12 or 13 for banks is very high. The yield for a 2025 dividend estimate of $1.75 is 5.2%. I'm going to do something now on for yield stocks, and that is I'm going to gross it up for the franking credit. So I take 5.2%, divide by 0.7, and I get 7.4%. So you as an investor, you're effectively getting a yield of 7.4%. For a yield company that's not got real growth, you're really buying it for that dividend and the franking. So thus 7.4 is something that you can then compare against bonds and other interest rate paying securities. The PEG ratio on NAB is 15. That's because it's not growing. It's got a PE close to 15. So 15 divided by 1 is 15. Now this is interesting. They had a very small lift in earnings estimates by brokers. Payout ratio is 75%. Now when they say very small rise in earnings estimate, I'm talking about 1 cent, 2 cent. It's one of the big four banks, as we know. They all have slow growth, low bad debts. That's significant because that allows them to pay out a large dividend. It is a yield stock, as I mentioned. PE is too high. It's got a terrible PEG. Why would you own it? Well, a few weeks ago, I showed you a chart that says people buy banks for one reason, and that's the yield. 7.4, it's not bad. Westpac, they reported this week, code's WBC, as most people would know. It's trading right now at $27.75. Take a look at the chart. It has really been on a run. It was low around $21 and it's taken off. So it's had a significant rise. But have the fundamentals changed at all? Well, looking at NAB, we don't expect it, but let's see if it's performing better than NAB. First of all, it has a market cap of $94 billion. I have a 12-month price target of $24.75. Some brokers are 24, others are 25. The price target really is a function of what kind of model you use. Discounted cash flow, yield base, Gordon growth, what have you. In my case, I look at the discounted cash flow. There's no sum of the parts here. PE, if I was doing it on a PE basis, I'd have an even lower price target. You have to be realistic here. It's a yield stock, price it off the yield. So let's go further into the numbers. The revenue growth from 2023 to 2026 is 1.2% per annum. The earnings growth is flat. The dividend growth is 2.5% per year. So it's a little better than NAB. Not much. Nothing to write home about and jump up and down. The PE on the 2025 earnings estimate of $1.91 is 14.5 times. This also is expensive. The yield on the dividend for 2025 at $1.48 is 5.3%, a little better than NAB, grossed up to 7.6. All right, so on a yield basis, Westpac, even though it has soared, it's still attractive. The PEG is atrocious at 14.5. Now, interestingly, companies that are having upgrades are ones that you want to look at. Westpac had decent earnings per share upgrades. Even with these upgrades, though, the growth rates are pretty poor. The CTI, which is cost to income ratio, is pretty high at around 51%. What this tells me is they have room to improve. Banks are having difficult time cutting costs, but at 51%, Westpac should be able to cut costs maybe down to 48 or 47% ratio. The payout is around 75, 77%. It's creeping up there. After COVID, the payout ratios were like 65, 70. Now, in order to get the share price up, they keep increasing the payout ratio, i.e. raising their dividend, to make it more attractive. That's one of the drivers of the stock price rising. Another reason banks were rising is because interest rates were starting to decline. That decline stopped when everybody realized, and central banks realized, that interest rates aren't probably going to be coming down anytime soon yet. Now, as one of the big four banks, yes, its growth is slow, the PE is high, you buy for the yield, just like NAB. Otherwise, there's many other companies out there on the ASX that are better acquisitions for growth. I rate it as defensive and neutral. Unless, of course, you really want the income and the franking credit, then by all means buy banks because they're relatively safe. Yes, they might go down, but long term, you're pretty safe parking your money in banks. Third company today, this caught my eye, and this is an amazing story. I'll spend a little bit more time on this than usual. This is Lyft. LYFT trades in the US. It closed at $17.65. Now, when I say close, it actually closed at $16.60, but in the aftermarket, it soared because they had a good report. Now, you take a look at the stock price, 5-year chart. It's been higher. So is this attractive or not? It looks like it's in a downtrend, although if you look closely at the far right, if I had a 1-year chart, it'd be a lot easier to see it. It's been coming back. It looks strong technically. Now, the second chart that I'm showing you here is a 1-year chart for Lyft, and you can see the rise much better. Yes, it's just the beginning of a potential large move up, but will it continue moving up? We aren't so sure right now. Professional Tape Reader, one of the newsletters, it's a technical analyst expert, would say this stock is now in a stage 3 because it's bottomed out and it's starting to move up. It's worth looking at. Now, as I mentioned, it closed at $16.60 and then soared to the current price. It has a market cap in Aussie dollars of $10 billion. Price target by UBS is $19. Now, this is where Lyft gets interesting. The revenue growth rate for 2023 to 2026 is 15% per annum. The earnings growth is 29% per annum. It pays no dividend. It's high growth, so that's fine. The EBIT growth from 2024 to 2026 is 36% per annum. Now, 2023 was a poor number, so I didn't want to distort the growth figures by using a lower number that then creates a really high return. The PE on the 2025 earnings estimate of $1.15 is only 15 times. So this company is cheap on a PE basis. Now, because it pays no dividend, no yield, so I just went straight to the PEG ratio. And using 2025 earnings estimates, I come up with a PEG ratio of 0.54. This means, as a growth company, it ticks that box. 2, it is cheap because it's less than 1.0. Now, looking at another key number in my book is free cash flow. This company has massive amounts of free cash flow. And it's generating positive earnings surprises. This is perfect for everybody who wants fundamental analysis and growth. Lyft is a taxi app company. It competes against Uber. They're profitable with lots of upside potential. That's what I look at. How much potential do they have? They're operating around the world. My son, his girlfriend works for Lyft, is a programmer that does programming for them globally. She tells me it's an excellent company. The stock analysts around the world are saying it's an excellent company. All the fundamentals say it's cheap. I would buy it. So take a look at it. If you can buy U.S. shares, it's worth considering putting it into your portfolio, putting it away, because this is something that could go up by a factor of 10 times what you pay over the long term, maybe even more. As always, if you want to learn more about any companies, send an email request to stockwatch@fnn.com.au and direct your questions to Chris Pedersen. Now, for next week, I'm going to cover more banks, and if you have any requests, please send them in, and I'm happy to cover them for you. Have a good week, and I hope it's profitable. Thank you.